At this time of year, many people think about where to invest their stocks and shares ISA. They wonder what state a stock market's in and ask themselves which areas are cheap and which are expensive. After a strong run in 2013, stock markets looked stretched at the start of this year. Markets bore this out when they fell in January, but then bounced back in February. Where does that leave the ISA investor? Are markets too high or about right? Now's a good time to look at some of the measures of the stock market. A basic measure of investment value is the price to earnings or PE ratio. PEs are often used to measure share prices, but they can also be used to measure entire stock markets as well. The PE is a number showing the price of an investment in relation to the earnings or profits that investment is generating. At the end of 2013, the developed markets of the UK, US, Europe and Japan had an average PE of 19. That means if you invested in those markets, the price you paid was 19 times more than the earnings of all the companies listed on those stock markets were generating. PEs vary a lot, however. Russia is one of the cheapest markets in the world with a PE of just 5, while the Eurozone appears to be one of the most expensive with a PE of 24. But the PE doesn't give you the full picture. It's a snapshot of an investment at a particular time. Robert Shiller, the Nobel Prize-winning economist, realised the PE was limited, so he devised one that measures prices against the 10-year average of earnings. It's called the cyclically-adjusted price earnings measure, or CAPE. The idea behind CAPE was that it smoothed the ups and downs of the economic cycle and gave a more stable measure. When you run the CAPE figures, you see the US, which had one of the biggest stock market rises last year, suddenly looks more expensive. By comparison, Europe looks cheaper. Whether the US market is expensive or not is important. The US stock market is the biggest in the world. Where Wall Street leads, other stock markets often follow. 5 years after the financial crisis, there are concerns the US and other stock markets are overinflated, following huge amounts of money printing by central banks. New research has shed some new light on this debate. It suggests some stock markets outside the US are more expensive than they may appear. Analysts at Barclays Capital argue that the CAPE measure does not account for differences in the composition of stock markets. For example, the technology giants of Silicon Valley account for 19% of the US stock market, far more than most countries. That's significant because tech stocks are typically more highly valued, have bigger PEs, than other sectors such as financials and energy companies, which tend to have lower PEs. These sectors dominate the UK stock market, by the way. When the analysts smoothed out the sector effect from the CAPE figures, they found it didn't make the US look much cheaper, but it did make other markets such as the UK look more expensive in comparison. Its CAPE figure rose from 16 to 18. What should you make of all this? A certain amount of caution is in order. At a multiple of 21 times, Wall Street is definitely on the expensive side. The long-term cyclically adjusted PE for the US is 16. Nevertheless, Shiller himself argued that the CAPE measure was not a guide to timing when you should and shouldn't invest in the stock market. He argued it was more of a guide to the future returns you should expect on your money. If you invest when stock markets are high, obviously you won't make as much money as if you invested when stock markets are low. But that's not the same thing as saying you will lose money. On that note, the Barclays research has some comforting news for people investing for the long term. It shows that the UK stock market has consistently beaten UK government bonds or gilts and cash, which are often used as the benchmarks for a safe investment. Over the past 10 years, shares have delivered an average real return above inflation of 5%, double what you got from gilts, while cash lost you money. Over longer periods, cash did better, but nevertheless, putting money in shares has more often than not helped investors grow their money.